We have so many options when it comes to the ways we can spend our money, and they're definitely not all good for us.
I would argue that it's not that the knowledge is inaccessible. It's more of like information paralysis.
That's Nate, and this is Money Questions.
That's Matt. This is Money Questions.
Money Questions will answer questions without a sales pitch.
Confidence, clarity, and some tools to make some important decisions.
This is season 2 of Money Questions.
It's wherever you get your podcasts.
I'm Matt. This is Nate. And we are answering money questions today. Okay, so
mid-June, end of June.
I don't know the exact date, but it was definitely mid-June.
We're too lazy to Google it. But in recent news, SpaceX, which is a thing that Elon Musk majority owns, went from a private company to a public company. And although our recordings aren't necessarily tied to current events, we thought it would be an interesting time to tackle what is a trillion.
Right.
Because it's the first time in history that an individual person is now a trillionaire.
Right. Or getting there at least, or getting very, very close.
On paper.
Yeah. On paper, a trillionaire.
He has not realized $1 trillion in his checking account, but his accountants, for all extensive purposes, consider him a trillionaire.
Right. And that prompted us to think about trillions.
Big numbers.
And big numbers and the concept of big numbers. And how our brain lies to us about big numbers because it has a really hard time conceptualizing big numbers.
Yeah.
Might not lie to us, but it struggles with big numbers, right?
Yeah. I'm always quick to reach for a spreadsheet.
That's right. Yeah. So big numbers can be hard to conceptualize, and so we wanted to talk about big money by talking about big numbers, right?
Okay.
And SpaceX had its initial public offering. They were kind of largely lauded as the first company to go public at $1 trillion. But a few seconds of Googling kind of puts that to bed, because there was another initial public offering, or IPO, where a stock went from private to public in 2019 that was valued at $1 trillion. And it was Saudi Aramco.
Yeah. Okay.
Yeah. So maybe it's because it's not a U.S. company that it was largely ignored. Yeah. Right. And so,
it depends how we consume our business news.
That's right. So while SpaceX is one of the larger initial public offerings, the largest, by a lot of people's accounts, there was a larger one. And there's some differences between those two, but we're not really getting into that today. Yeah. We're just giving you the reason as to why we arrived at this topic, right?
Yeah.
And so
it's a fun summer topic for us. Yeah. So how about we go back in time? Let's put $1 trillion in context of time.
Absolutely. Yeah, there was a fun analogy in here when we were doing our research that helped to conceptualize the concept of even just $1 billion, right? And it's here. If you spent $1,000 every single day since Jesus was born, you still wouldn't have spent $1 billion. You'd only be at around $740 million. So when someone says they're a billionaire, it's hard to picture. It's hard to picture a human being, because we should be really picturing an immortal spending spree wizard of some kind, because it's almost impossible to spend that kind of money, let alone earn that kind of money.
Yeah.
Right. And to put it in other context, I guess, maybe the reason there's limitations around how we think about these large numbers is because, our brains were evolved and formed millions of years ago to.
I thought you were going to pivot and get into a very deep conversation about life, time, and longevity.
No, I was just going to say that evolution prepared us to count mammoth herds as opposed to the market cap of companies or the GDP of countries.
Yeah. So how long is a million seconds?
A million seconds is 11 and a half days, right? That's a solid vacation.
Yeah.
You have about 1 million seconds.
So if you times that by 1,000...
Right.
How much is 1 billion seconds?
1 billion seconds it's about 32 years.
That's a long time.
Right. So a huge difference between 1 million and 1 billion, even though the difference is one letter.
Yeah.
Right.
But I guess in context of a human life participating in society, what are the typical things you could do over a 30-year period?
Oh my gosh. You could have a career. You could pay off a mortgage. Yeah. You could raise children. They probably won't move out yet, though.
Yeah. So that takes about 1 billion seconds.
Right. I actually have a a poster framed at home that I've yet to put on my office at work. I have one for you too, actually.
I know. It's a little morbid and I like it.
Yeah, but it's a poster and it's a grid of squares and it's your life in weeks.
Yeah.
And every line in this grid represents a year. There are 52 squares along the top and there are about 90 lines of those squares. Mm-hmm. And so the idea with this thing is you color in each week of your life as life goes on.
Yeah.
And it helps to throw your mortality in your face every day.
That's right.
As a reminder not to waste time.
Yeah.
And to, use our time wisely. So taking it from $1 billion to $1 trillion is mind-boggling.
Yeah. So if we go to $1 trillion, how many years is that?
So we at $1 billion, about 32 years. It's 31.7 years. At $1 trillion, it becomes 31,700 years.
Oh.
Right. So going back to the Stone Age or before written human history was ever a thing.
So I'm just reading the show notes and quick math on that. It's 1 billion times 1,000.
There you go. Yeah. Yeah.
You even write that. I did the math in my head.
Pretty good.
I just moved the zero.
You're advisoring.
I'm advisoring, right?
The other analogy that's, popular in childhood textbooks is stacking things, right?
Yes.
So just as a fun thing to do, we could say, $1 million stacked in $100 bills. It's only about 4 inches high, right?
Really?
Doesn't seem right, does it?
That's
$100 bills, right?
Then what are
So it's
I have so many
10,000
I have so many
bills?
thief movies in my head with briefcases of bills.
Right.
They must all be 20s.
They must be 20s.
They must be 20s.
Yeah, exactly.
Okay.
They're not using pallets.
Okay.
Right?
So
you would have to use pallets for $1 billion.
Okay.
Because
How high?
$100 bills stacked, or $1 billion in $100 stacked is 679 feet into the sky. Mm-hmm. About as tall as the Washington Monument.
Okay.
Or what's a local monument that we can compare to the Washington Monument?
I don't know how tall Citadel Hill is from.
It's probably close, actually.
Some water from the Halifax Harbor.
It's probably about as tall as Citadel Hill. I'd say the Washington Monument and Citadel Hill are probably pretty close, right? Ours is way cooler.
Okay. We'll actually fact check that at some point in time.
We won't. $1 trillion in $100 bills stacked, one atop the other, is 67 miles high, literally into space. Mm-hmm. Right. So again, these are hard numbers to conceive of, and it can be very difficult to kind of conceptualize what saving a good amount of money is. We have conversations with 20-year-olds saving for retirement, mm-hmm. and it's really hard for a lot of people in their mid-20s to conceptualize what they're going to need in their 60s. So, it's no wonder it's hard for us to conceptualize these kind of numbers, right?
Absolutely.
Getting back to how this operates within the context of finance, we have multiple trillion-dollar companies in existence today.
Yeah, but where were we 10 years ago?
We had zero.
Oh, okay.
And there was $0 trillion companies in 2016. The largest company in the world back in 2016 was Apple.
Yeah, they were at least halfway there,
right? And I think when people, they were about 500 to 600 billion, right? And at that time, people were saying, "Oh, if they reach $1 trillion, it's time to get out," right? Because
the government needs to regulate them. They're too big. They're too big to fail.
That's another topic in and of itself. The U.S. has largely stopped persecuting or prosecuting antitrust suits. So you have these giant companies mm-hmm. that weren't around before, and maybe that's partly because of the legal situations down in the U.S. and how they're starting to give these large companies more and more leeway. But now, 10 years later, they're over $10 trillion giants. And so among that list is still Apple. Mm-hmm. Nvidia is probably the most well-known one today in that, they're in the news in regards to AI chips and how much business they're doing and how much cash flow they're generating. Microsoft, Alphabet, or Google, as most of us know them.
Okay, I see Amazon there.
Yeah, Amazon, Meta, Taiwan Semiconductor.
More computer chips.
More computer chips, mostly tech companies, right?
Hey, Warren Buffett's there, though.
Yeah, Warren Buffett is there. Interestingly, Warren Buffett, who's got a lot of money, has amassed most of his wealth in the last decade. Yeah. And that's a funny thing about compounding, right?
Yeah, but we'll tie that back in at the end.
We will tie that back in at the end.
So let's talk about the S&P 500, which is an indice used to track the 500 biggest companies based on their market capitalization or their size or their value.
Yeah.
So how is $1 trillion represented in that index?
Yeah. So I guess for context, the largest 500 companies in the world are represented by the Standard & Poor's 500. This is a popular index fund that people invest in. Mm-hmm. You can buy all 500 companies, by purchasing one index, and then you have diverse exposure to all these companies. I guess a lot of people think just by buying that one index, they've got a diversified portfolio. I've got 500 companies.
But the actual index, correct me if I'm wrong, it's weighted on size, right?
It is weighted on what they call market cap, which is essentially size.
So if you're looking at $1 trillion companies, how many are hanging out in that index? And how much of that index do they represent?
So out of the 500 companies in the S&P 500, depending on the day, because the markets fluctuate every day, there are 10 to 12 companies that are $1 trillion or larger. And so what that does is, if you think about, the largest company at $3 or $4 trillion and the smallest company at maybe $100 billion. I'm not sure exactly how small the smallest company in the S&P 500 is. But what that means is you have an overweight exposure to the largest companies when you buy the index. So by virtue of buying the index, you're actually putting about $4 of every $10 you invest in that index.
Oh, in that 10 to 12 companies.
In that 10 to 12 companies. So one could argue that's actually kind of concentrated. That's not very diverse. And so this is just a consideration for people thinking that they're diversified by buying one index, right? They are
taking into consideration their investing goals,
right? Yeah,
their
absolutely.
time horizon.
Yeah. So the total market cap, I guess, of the S&P 500 is somewhere between $65 and $69 trillion, depending on the day.
Okay.
Right. So it's about 80% of all U.S. companies are valued within that index.
So 10 to 12 companies represent over a third.
Right. Okay. Right. Yeah. So
that's a good way to think about it.
Yeah. And so, when buying the index, one has to consider that they're exposing themselves pretty heavily to those companies.
Okay.
And so what happens is those companies start having an oversized effect on the ups and the downs in the market.
Okay. So let's flip it all on its head there. Like, how does one get to $1 trillion?
Oh, geez.
When it comes to growth.
Right.
How much water do you have to pour on a plant for it to grow into $1 trillion?
Right.
That's a bad example. We probably should cut that.
No, I like that. So a good explanation or a good concept to help explain this is something called the rule of 72.
Okay.
Right. The rule of 72 dictates.
When you divide something by something, right?
Yeah. So you can determine how long it will take your money to double. If you take the rate of return that you're earning and you take that number and, you take 72 and you divide it by that number. So as a quick example, you have a rate of return of 7.2%. If you take 72 and you divide it by 7.2,
that means your money doubles in 10 years.
Yeah, you got it.
Okay.
You did well in math.
I didn't need a spreadsheet.
So at a rate of return of 7.2%, your money will double every 10 years.
Okay.
And so that's a good concept for people to think through when they're considering a conservative investment as a long-term investment, because someone might look at a high interest savings account or a GIC where they're earning, 2% these days. It wouldn't be an unusual number for them to earn in that type of an account. It would take 36 years, according to the rule of 72, for their money to double in a 2% investment,
yes.
in an investment returning 2%.
Yeah.
Right. And conversely, if your investment's on fire, doing really, really well, and you're earning 14%, then your money's going to double every 5 years. So money can snowball pretty quickly,
yes. depending
depending on the rate of return. So starting with $10,000, your money will double at 7%. To 20K after 10 years, to 40K after 20 years, to 80K after 30 years. So that's why we often hear in personal finance that time matters more than timing.
Because 30 years is a career.
Right. Yeah. And if someone starts earning or starts saving and investing at the age of 30 and they, would like to retire around the age of 60, if they think about their savings in terms of doubling periods, it can be helpful to them in order to think through what kind of investments they want to put their money in.
Yeah.
Right. You don't necessarily want to put it in something earning 2% over that long period of time.
Yeah. And then there's some fancy math on there when you can index the rate of saving based on how your paycheck grows or doesn't grow.
Right.
Or as your salary grows,
Yeah, it's a good point.
Yeah.
That's a good point. It's a conversation.
You don't necessarily save $25 a paycheck for your whole life.
No.
Ideally, it becomes a meaningful part of your household budget.
Absolutely. And I mean, it's a conversation that I typically have with younger clients, not even younger clients, all clients that are still accumulating early in the year when we're having sort of the beginning of the year conversation. And these are people that are accumulating funds. It can be really difficult to go from saving, say, $100 a month to saving $500 a month. Mm-hmm. But if you index or if you just increase your savings rate a little bit every year, mm-hmm. then you don't really feel it as much. You'd feel going from $100 to $500 a month. That might break mm-hmm. some budgets.
I was thinking about this morning a little bit, but because time is your friend when it comes to saving for the future, mm-hmm. It can really dictate how much risk that you need to take in order to accomplish your retirement goals mm-hmm. or like replacing your earned income when you're ready to transition into retirement, right?
Yeah.
If you start early enough and you're playing with that rule of 72, mm-hmm. you don't necessarily need to take a lot of risk in order to accomplish your goal of retirement.
Yeah, for sure.
Yeah.
For sure. Or conversely, if you're not willing to take a lot of risk because mm-hmm. you're risk averse, mm-hmm. then your savings rate is the other dial you have to turn.
Yeah. But not more often than not, but I see a lot. Hey, I want to retire in 5 years or 10 years.
Right.
How much do I have to save or how much do I need to earn per year in order to accomplish my goal?
Right.
And I'm like, ugh, that's gambling.
Yeah, absolutely. Yeah, absolutely. There's only, because you only have control over one of those two things.
That's got a couple levels, right?
You can control your savings rate and have full control over it.
Yeah.
You can dial it up and down how you want. It's harder to dial your rate of return.
Yeah.
Because
and time is time.
Absolutely. Yeah, time is time. We haven't figured out a way to
stop time.
Yeah.
Time travel.
Or just augment that in any way.
Yeah. Back to the future type thing.
But your savings rate is often going to have a larger impact on your long-term savings than the rate of return. Mm-hmm. This is a dirty little secret of investing in that, what you do is a lot more important sometimes than what your advisor does for you, right? Like the money that you earn and the earning power that you have. Mm-hmm. Those two things, if you can bolster those somehow, if you can increase your rate of savings, that's going to have a huge impact on your long-term success.
Yeah.
More so than a lot of other things.
Yeah.
Right?
Instilling good behaviors early on in life mm-hmm. Tends to increase for a better chance of success, right?
Well, yeah. And getting back to what you were saying about the type of risk you take depending on the time horizon, like a lot of people, even if they were to receive a big inheritance or a windfall, they may have been a little uncomfortable with the risk that they were taking up until that point. And then all of a sudden they receive a lump sum of money. And more recently, someone, a client of mine sold a business and he always expressed a little bit of discomfort with his, with the risk he was taking.
Yeah.
But was always adamant that he wanted to continue taking it in order to grow his wealth.
But that's because the majority of the risk it was taking was within his career and within the ownership of that business.
Yeah, absolutely.
That's a very concentrated bet and you're betting on yourself.
Absolutely. So when that changed for him, I think, he had the epiphany. He's like, I don't need to take this. That's the same kind of risk that I have been taking up to this point. Like mm-hmm. I can calm down a little bit.
Yeah. No, that makes a lot of sense. So let's sort of wrap this up. This is sort of a good summer podcast. Like what are the so whats here? Yeah.
One of the so whats is when it comes to growing your money, going from 1 to a trillion, if you will, mm-hmm. A lot of the compounding is backloaded.
Yes.
So, when you're first starting out and you're saving your money and your money's growing, it could be growing at a good clip too, but you're starting from a low base, and from a low base, the results aren't as obvious. And so the first decade or even 2 decades of saving and investing can be a little frustrating because you're not seeing the results that you'd like to see. You're not seeing, your account hit 6 figures as fast as you'd like to see. And so, it can be a little bit frustrating. So I think one of the takeaways here is as annoying as it is, this is one of those things that just takes time.
Yeah, absolutely.
Right. And
like the snowball tends to start rolling faster as it gets farther down the hill.
Right. Yeah. Going back to Buffett, Warren Buffett, one of the world's best investors, right? Like most of his wealth came after the age of 65. And the man is, well into his, how old is Warren Buffett? Do you know how old Warren Buffett is?
I'd say late 80s, but I'm guessing.
Let me see. How old is...
Another good example of that is, do you ever read the book? I think it's like One Red Paperclip.
I have.
Yeah. How you take
I haven't read it. I heard about it.
It's really cool because it's just all about taking a paperclip and trading up into, I think he got all the way to like a family home.
Yeah. I think he got all the way to a house for sure.
Yeah.
Warren Buffett's 95 years old.
Okay.
Right.
I was way.
Yeah. And most of his wealth was compounded
over the last 10 years?
Over the last 10, 15 years.
Yeah.
Right. He's worth roughly, what is this? 147 billion. He's one of the top 10 wealthiest people in the world, but most of that wealth came after he was 80. Anyhow, as far as wrapping up trillions goes, don't be intimidated by big numbers, right? We have to understand that compounding does the heavy lifting for a lot of these things, and it happens late in life. No one needs to save $1 trillion for anything.
What do you have here? You have a watch your index funds. Do you just mean understand how they work?
Well, yeah, I think in the context of these $1 trillion companies inside an index fund, so the S&P 500, there's various index funds that track the S&P 500. It's largely regarded as, a really easy set it and forget it investment. The warning here, I suppose, is it's becoming very, very concentrated in those top 10 to 12 trillion dollar companies. Yeah. So it's not as diverse as it was even 10 years ago. And a lot of people don't know this, but in the years between 2000 and about 2010, the S&P 500 returned to nothing. It was negative. Yeah. There was a big technology company run up in the late 90s. A lot of people made a lot of money, but in the years following that big run up, people made zero money. So there is a kind of a mean reversion that takes hold eventually. Things get back to normal. And so these periods of huge outsized returns are often followed by periods of low to no returns. And so, something like a global equity index might be more appropriate. What's the
saying? Like history doesn't necessarily repeat itself, but it rhymes.
But it rhymes. Yeah. There you go.
Yeah. So I guess the so what there within that is to just understand diversification within your investment goals.
That's it. That's it. And
you got one more point here. Patience over panic.
Yeah. Yeah, that's more about being patient in those early years of saving, right? We all want to get to the big number. We all want to get to the retirement goal. But the graph of exponential growth looks a lot like a hockey stick, and it kind of climbs slowly over time, and then eventually compounding takes hold and it just kind of hooks up and to the right. Yeah. And so you have to get there. You have to get to that hook up and to the right to enjoy the benefits of compounding. And that happens after a couple decades usually. Yeah.
Time is your friend when it comes to saving for the future.
That's it. That's all.
Did we do another episode on compounding?
We did. Yeah, we have an episode on compounding.
Can we link it somewhere?
We can. I think we can link it.
Can we link it?
Yeah. Yeah. We'll link that.
It's right here?
Yeah.
Or here? Below here? Over here?
It'll be in one of those places. Maybe all of those places.
Oh, that'd be weird. I watch too much YouTube.
Listen and subscribe to Money Questions, wherever you get your podcasts.